Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I'm here with Phil Mackintosh, Nasdaq Chief Economist. Phil has over 28 years of financial industry experience, including roles on the sell side, buy side, and at accounting firms, which included managing trading, research, and risk teams. He's an expert in index construction and ETF trading. And prior to joining Nasdaq in 2018, he was head of trading strategy and analysis at KCG Virtu Financial. And he also served as global head of trading strategy at Credit Suisse. He's published research on indexes, ETFs, market structure, trading, and retail investors. And he's also host of Nasdaq's Total Markets podcast. Phil, thank you for joining me today.
No problems. Thanks for having me, Ed.
We're going to talk about retail investors and retail trading. That's kind of what we want to try to tackle today, especially since COVID and over the summer. And I think you have some great insight on that. And you've written a little bit about that as well.
Yeah, I mean, I would say if there's three things that have been interesting this year, one is the huge increase in retail trading. The other is what COVID has done to the markets. And the third is what the markets have done because of COVID. So we can talk about retail in terms of what the COVID has done to the markets. We've obviously had a huge amount of volatility. We've hit market-wide circuit breakers, spreads wide, and ETFs really performed pretty well throughout all that. In the middle of the bond market sort of freezing up when the Fed hadn't come in to rescue it yet, the ETFs were probably the thing that was giving bond market liquidity. So we've been spending a bunch of time researching trading throughout this. And then in terms of what the market's been doing with COVID, there's been some really interesting trading activity. In ETFs, it's been pretty obvious. A lot of people putting on trades in the sort of COVID trade space, whether that's online retail, semiconductors, cloud and software, even gaming ETFs. It's been fascinating to watch. And then every time you get a spark of news on the vaccine or treatment side, you get all those ETFs trading as well.
Yeah, it's been a fascinating time. Just kind of before we jump into that, how have you personally handled the whole COVID experience? And I assume you're working from home as well.
Yeah, I mean, we were actually forced to work from home when my daughter's school closed down back in March, and we kind of just left everything in the city and came up. We're a little bit upstate where we live, and we had to do a couple of emergency runs back into the city because we just didn't think it was going to take as long as it's taken. But, just getting summer clothes for our daughter and going back in and getting extra textbooks for her, it's gone on a lot longer than I think we all expected at the start, hasn't it?
Yeah, I know one of the other big trends right now is moving out to the suburbs or trying to get away from the city, and real estate's going gangbusters and the neighborhoods around the city, or outside the city, I should say.
Yeah, V-shaped recovery in that segment of the market, that's for sure.
Maybe we could spend a little time on your background and perhaps with your current role right now as a chief economist. How do you spend most of your time, and what do you spend most of your time doing for Nasdaq right now?
I mean, that's a really good question. And you kind of introduced me, and I've obviously spent a lot of time on the sell side doing research on trading and liquidity and managing ETFs and looking at how market makers make markets and ETFs. So I do a lot of that, like microeconomics still for NASDAQ, looking at the market makers, the market quality. But because now we've got issuers that come to market to list stocks, I'm talking to those guys as well. And that's a lot more of a macroeconomic discussion. Talking about what's driving the market, what's driving valuations, what's driving different sectors. So it's been really interesting. I've been probably busier than normal just because any information seems to be valuable information right now. And I've been talking macro and micro.
Did you guys see an impact in terms of new product listings, ETF listings, and stock listings? And is there a noticeable impact now that we're kind of starting to come over it? Do you think that maybe more stocks are trying to list?
So that's kind of an interesting question. I mean, we're having a gangbusters year on the listing side. The corporates that are coming to market are in a big rush. We obviously, in the middle of the sell-off and all of the volatility in March, the IPO market pretty much dried up, which it always seems to when you have the initial spike in volatility. But once the valuations came back a little bit, we had a lot of companies that wanted to come to market, and some of them, needed some capital to get invested into what's going on. We've had some biotech companies that are researching vaccines or treatments, a lot of tech companies that needed extra capital, maybe even just secondary market capital to sort of get going with the platforms that they've got for working from home. And also we've seen, obviously it's been in the paper, a lot of SPACs. So it seems like the private equity market has started to look at listings as a way of sort of getting themselves exposed to some of these new companies coming online. I guess maybe that speaks to the fact that doing roadshows in this environment is a lot harder. And so having a SPAC that can research you and bring you into the listed market is helpful. So I think that's been surprisingly busy. On the ETF front, I haven't seen such a rush of new ETF tickers. I know the news is that there's actually been record shutdowns of ETFs this year, but we've started to see obviously some of the active non-transparent products coming to market, and there's still been new ETFs coming to market as well, and lots of activity in the ETF space across lots of different thematics too.
Yeah. There's definitely the thematic side. We're seeing a lot more activity there, as you mentioned, and will continue to be interesting to see how the active non-transparent structure takes off in the ETF space. Going back to retail investing, when we talk about retail investing, we're really talking individual investor, right?
Yes, that's what you'd think. It's kind of an interesting question when you actually live in the markets. We all know what a retail investor looks like, but how do you define that? And so there's a few different definitions. One of the definitions is it's got to be a natural person, not an algorithm that's creating the trade, not an institution, not somebody managing more than $50 million. There's a bunch of different rules out there. Not all of them apply at the same time. But what actually tends to happen for most retail traders is they come through what we would classify as a retail broker-dealer. You know, a Charles Schwab, an E-Trade, a TD Ameritrade, or like a Morgan Stanley private bank. And so those institutions actually tend to sign an attestation that FINRA has created that says most of this flow is from natural people. And so that's kind of how the industry decides what's retail and what's not retail. When you look at the kind of flow that they're using or they're sending, it does average a pretty small trade. It's about a $10,000 trade, but mixed into that is some larger trades as well. So sometimes you'd see multi-million-dollar trades coming through a retail broker, which some of us might not think sounds very retail.
And so basically the way you're able to discern flows and trading activity from retail investors is from those attestations and the flows coming from those firms that have made those attestations, and then the size of the trade kind of generally, right?
Sort of. So for me, living in an exchange world, I don't actually really see the attestations that much. Most retail trading is actually sent to a wholesaler, which is a market maker who will fill that trade off exchange, which is something a lot of people don't know. So I don't really see that much of the retail flow, but there is disclosures in the market that FINRA does, which is our regulator, one of our regulators, and you can sort of deduce from those disclosures how big retail probably is, because retail, just because they tend to trade the way that they trade direct to a wholesaler, tends to pop up in a specific column of the disclosures. So that's how I would tell how busy retail is and what they're doing.
Now, the big news and the headlines really in this summer with regards to retail trading or individual investor trading has been, I guess, the return of it and the return of even day trading. Do you think that was largely due to COVID? Are there other factors to consider that help spur that along as well?
Yes, I mean, a lot of people are talking about the free commissions as spurring the growth in retail trading. And it's true that retail trading definitely has an uptick. If you look at the reports, the quarterly reports of the big retail broker dealers, some of them have had more than doubling of activity. It started when free commissions happened. That was sort of September, October last year. But really the big uptick, if you look at the data, was when everybody got quarantined back in March. So I think COVID has had a much bigger impact in the uptick. Maybe the stimulus helped with that, because when you look at the data, a lot of the stimulus money has been saved, not spent. And so potentially a lot of the people that are new to the market are, at home, not working so hard, and maybe they've got some extra stimulus money that they're investing too.
And then from your perspective as somebody in the markets, how do you characterize their activity in the marketplace? Is that a good thing, or is that potentially negative to have day traders in the market?
So, firstly, I don't think most retail is day traders. If you look at some of the old reportings before free commissions, the average account would trade about 12 times a year. And even when you look at some of the smart beta ETFs, you can tell they're not being used so much by hedge funds because hedge funds can do smart beta themselves, but they get used more by retail. And the turnover of those ETFs is closer to 1 time, 2 times a year. So the average hold is, for most retail, the average hold is months or maybe years. There's obviously a component of retail that's going to be a much higher turnover trader. It's difficult to tell from my space in the exchange how many of the retail traders are like that. But I think in general, retail is not as active as you'd think.
Do you think that the uptick in activity will continue after there is a virus or people start going back to work?
Really good question. So when you look at the numbers, it looks like retail's roughly doubled. We've also, if you look at the options data, we've seen record options volumes this year. Obviously, options are good products for hedging and ensuring your portfolio against volatility. So it's not all retail that's doing that. With COVID around, there's a lot of people that probably want to hedge, but it definitely looks like retail has picked up significantly in the stocks and the option space. I think you're right. I think when people are all fully employed, they'll be a bit busy again. And maybe they'll sort of step away from their portfolios. But the reality is, and kind of coming back to your earlier question, the fact that retail is getting into the market in a bit bigger way is a good thing, really, for retail and for stocks. Like for retail investors, if you look at the statistics, the top 10% of homeowners by wealth own almost all the stocks. And the bottom 50% own almost no stocks. So if some of that bottom 50% is starting to buy stocks, that's a good thing for them, because if you look at the performance of homes or bonds or stocks over the long term, stocks outperform. And so the fact that all of these lower income people have traditionally been underweight equities and underweight stocks has hurt them longer term in terms of how much wealth they're able to build. And also from the issuer perspective, it's really interesting to look at the stocks that have heavy retail volume. They tend to be much more liquid. And so more liquidity tends to make it cheaper to trade, which reduces the cost of capital for corporates, makes their valuations go up. So having more people in the market is mostly a win-win.
In terms of the types of ETFs and or stocks or maybe strategies that you've seen pick up in trading, can you talk a little bit about that, kind of what you're seeing in terms of high activities in certain ETFs or certain stocks?
Yeah, so we actually started just before coronavirus looking at ETFs, and rather than just look at the ETFs that had the most volume or the most assets that came in, we tried to work out like relatively what had the greatest change in volume or the greatest change in returns or the greatest change in assets. So which ones were growing or appreciating the fastest or saw an increase in trading activity that was the greatest. And it's been really interesting to look at that because ETFs like SPY and QQQ are so big, they dominate most top 10s. Doing it this way, we've actually started to see a lot of thematics. Week by week, we've seen completely different ETFs being traded. I would say overall, seen a pretty consistent new economy trade. So ETFs in the tech space, online retail, cloud, software, semiconductors, gaming, you name it. Anything that's kind of got exposure to things like, Amazon and Netflix and Apple and Microsoft has been doing pretty well. But we've also seen, the weeks where there's good vaccine news. Some of the biotech ETFs have traded a lot and traded with inflows as well. At different times of the cycle, like I remember after we were quarantined, we sort of started to realize that, hey, there's going to be no one demanding oil anymore, and suppliers of oil can't just shut down. So we had a period in April where there was a big supply-demand imbalance in the energy market, and people used ETFs there. And then a bit later on, when we started to realize how much stimulus money was in the market, sort of, I guess, August-ish, we saw a really big precious metals trade. Where people were obviously worried about that inflation impact coming from the stimulus money as people came back to work, stop saving, start spending, the velocity of the money increases in the economy. And, typically economists would say that's going to cause inflation. And for a couple of weeks, our top 25 ETFs was metals and miners in the precious metals space almost exclusively. It was pretty interesting to watch.
Have you seen traders or individual investors play in other areas, maybe bottom fishing or looking for not necessarily the momentum names, which it seems like everybody's in, but have you seen individual investors playing in mid caps or small caps or other parts of the world?
Yeah, I mean, obviously the value growth disconnect is pretty stretched right now. I've seen some charts that show it's at a record level where growth is extremely rich versus value, and that's definitely been stretched during the coronavirus sell-off. A lot of the companies that are benefited are your classic high growth stocks like your Amazons. As you get news of vaccines, as you get news of health improving and people sort of bending the curve on COVID, you've seen value and small cap being bought for weeks at a time. Those stocks are both, or those kind of segments of the market are both pretty beat up and have definitely, sort of fallen behind the recovery trade. So if we get a vaccine and we start to think about really getting back to normal next year, those are segments of the market that could definitely have a catch-up trade. The other thing that we've seen in terms of bottom fishing, I guess you'd say, is airline stocks and the airline ETF. I mean, super active. Initially, it was being sold because airlines were pretty negatively impacted by this. But once we knew of the rescue plans, it was bought. And then we've seen since that maybe the rescue plans are going to run out and they've been sold. So that's a sort of leverage play on the COVID recovery trade as well.
Going back to retail investors, what are some of the most significant differences you see between retail investors and, say, professional investors that are in the market, and how they operate and how they trade?
I guess it really comes down to their trading size, but the way they trade is completely different. So retail investors, because they're pretty small trades most of the time, because they're coming through attested as retail and going to wholesalers, basically the wholesalers look at where the bid and the offer is on the exchange and fill that customer at no worse than those prices. If you're an institution, you can't use those avenues for trading. And so institutions, instead of trading $10,000, they might be trading $10 million worth of a ticker, which means they have to go to a bigger broker dealer with algorithms. They're going to chop that order up, maybe work it in a dart pool, work it in all the different exchanges, try and capture spread, try and cross the spread. And over the space of a day, they'll get $10 million worth of that stock done, trying to have no impact, trying to have no signaling. So, I mean, completely different problems to solve from the perspective of the game theory of trading and how to not show your hand. Institutions use dart pools, they tend to use algorithms. Retail investors tend to be able to just send an order to a wholesaler and get a fill back. It's almost two separate markets that run in parallel. And nicely, both of them are held accountable by a thing called the National Best Bid and Offer, which is put together across all the different exchanges. The best prices from each exchange are brought together. I guess you could say it's a little bit like Priceline or Kayak.com, but for stocks. And so when you're looking at your screen on Schwab or E-Trade, exactly where the best bid and the offer is, and the broker works out where to send it.
How do you think the share price of a stock or an ETF influences an investor's decision to buy?
I'm guessing what you're asking about that is whether high-priced stocks deter retail investing, because there's a train of thought that says that's true. There's a little bit of research that supports that. We definitely see evidence in the data we look at where very high-priced stocks tend to have more options activity. And talking to retail brokers, that's because it's just too expensive to buy 100 shares of a $2,000 stock. And so people tend to buy a 50 delta option on it, which is obviously costs half as much to get in. It's a little bit of a levered play, but at least you haven't had to put down so much capital for that single stock trade. But in terms of like the academic research, if you split your stock, do you get more retail investors? It's a little bit mixed. There's a couple of studies that say that that's true, but there's other studies that say there's not really much difference. And I would argue when you look at the data, the stocks that retail like to trade are actually the stocks that we all sort of feel like we know. So it's your Facebooks and your Amazons and your Netflix and United Airlines. It's a lot of the tickers that you're using on a day-to-day basis. So you feel like you're a bit more comfortable about their business model and you don't probably have to do as much research. You find a product you like and you buy it.
Yeah, didn't Apple just go through a stock split and then it took off again after that?
Apple and Tesla. And if you look at the research, I mean, two stocks doesn't make a really good statistical sample, but if you look at research over decades, stocks that split tend to increase in value by around about 5%. It's almost the same as the boost for being added to the S&P 500. And so what you're seeing with stock splits is some of these really high-priced stocks have basically some trading difficulties. It's too hard to put 100 shares on the bid and the offer for a market maker. It's just too much capital to have at risk. Algorithms are the same, so they end up chopping the orders down into odd lots, which you don't quite see, and there's too many increments, so people can kind of penny you on the spread and get in front of you in the queue without actually paying for it. And we know how frustrating that is when people jump the queue in a supermarket on us. And so you could create some tradability problems. When you stock split down to a better stock price where the spread is more appropriate in sense, you actually get much cheaper spreads. You get more liquidity. And because of that, the market price is in. Lower trading costs equal better returns. Price goes up.
Do you see it working that way for ETFs as well?
That's a really interesting question. So when you look at the ETF spectrum, most ETFs tend to cluster at around about $25. Obviously not all of them, but I think ETF issuers intuitively or not know that $25 to $50 is a really good stock price range to ensure that the spread is worth capturing, but it's also not so expensive that it's not worth crossing. So you kind of have that sweet spot between an urgent investor not paying too much to lift the offer, but a passive investor making it worth trying to provide liquidity. And so ETFs tend to cluster around what would probably be their perfect stock price. There's a couple of exceptions, and I think on the upper end, you look at some of the tickers like the Qs and the SPYs, they actually have so much liquidity they can justify their higher prices. They still price 1 cent wide, even with multi-$100 stocks. But you've got to have a lot of liquidity to justify that and to actually make it work.
In terms of commissions for individual investors and retail investors, at a lot of places it's gone to nil in terms of just the commission. But what other cost do investors need to keep in mind?
Yeah, good point. I mean, and I think there's people on my LinkedIn feed right now telling me that commissions are zero, so there's no cost to trade. That's just not true. There is spread costs, where spread is the difference between the bid and the offer price. Obviously, the offer is the person that wants to sell, and they want to earn more money than the guy that wants to buy. And so the market always has a spread. And so if you're urgent, you're going to have to pay what the seller wants. And so you're going to cross that spread. That costs money. Even if you're a retail trader sending it to a wholesaler, you're going to pay some of that spread as well. So there's spread costs. If you're buying ETFs, there's going to be some management fees built in. If you're at a broker dealer where you've got free commissions, you might instead be paying for your account in other ways. There might be lower interest rates paid on your balances. There might be higher interest rates charged on your mortgage. At the end of the day, the companies have a business model that's platformed and sort of bundled. And so they just need to make sure that everything fits together the best that it can. So there are going to be ways that people pay. Just because it's commission free doesn't mean it's free.
Are there ways that investors can improve their experience or kind of protect themselves as they trade?
I mean, I think the most obvious way to protect yourself as a trader is to use limit orders, not market orders. That doesn't mean you have to sit on the bid if you're a buyer. I mean, you can see that the market is bid $10, offered $10.05. You could bid for $10.10. At least that way, you're not going to get worse than 5 cents through the offer. What's a risky proposition is putting market orders into the system because you can theoretically trade with all of the liquidity on the offer and the next price and the next price and get a fill that surprises you on the downside because you get a bad fill. So I would say using limit orders is one of the best things. The other thing that, especially with ETFs, is important is just to understand where the net asset value of the ETF is. So if the ETF underlying portfolio is worth $25, don't bid 40. Maybe you could bid $25.10, or you could be cheeky and try and bid $24.90, but make sure that your limit price is roughly the same as the underlying basket price.
In your prior role, or maybe in your current role now, I was just kind of curious what your thoughts are in terms of some of the thematic ETFs. We look at our business and we have ETFs that we refer to as trading ETFs. They're very, I'll call it beta oriented or directional oriented. You want to trade steel, or you want to trade video games or whatever it is, or gold miners. It tends to be a tactical trade type trade. And then we also have allocation ETFs, which are more buy and hold. Those trading ETFs, what has been your experience in terms of the type of investor that uses those? Do those tend to be, do you see active individual investors in those ETFs, or does it tend to be more professional traders there?
I mean, you definitely do see individuals, because some of the thematics make total sense to be buying, right? It's just like we talked about with the COVID trade and everyone wanting to get into online retail or robotics, or, a lot of those thematics actually kind of make sense if you're trying to construct a portfolio for yourself. But those thematic ETFs also are pretty attractive to hedge funds. So what you tend to see is there's about 100, maybe a few more than that now, ETFs that are really liquid, have high turnover compared to their assets. And the hedge funds focus on those ETFs. Like you said, they're pretty clean beta products. And so the hedge funds aren't really paying anyone to go manage the stock picking, but they're paying somebody to put together a basket of a thematic that gives you an exposure that you want, that's reliable. And so we see a lot more hedge fund activity in those super liquid, more straight up beta products. And then you look at some of the products that retail like more, and it tends to be the smart beta, where you are paying someone to pick stocks, whether it's with an algorithm that goes and finds cheap stocks, or whether it's actually humans, with some more fundamental models and doing active ETFs and the new active non-transparent space. The retail flows into them tend to be a bit stickier. You might not have as high a turnover, you might not have as high a liquidity, but the assets tend to accumulate in them much more consistently over time. Whereas some of these thematic products, they'll get interesting and then they won't be interesting, and people kind of move on to another asset class, because that's what makes sense.
That's right. Yeah, they can be super volatile, those very thematic ETFs.
Yeah, but not volatile in a bad way for the ETFs. I mean, the thematic itself might be volatile. Actually, what you tend to find, and we found this even with the airline ETFs right now. I mean, the airlines sold off 70, 80%. They bounced back, almost doubled from where they got to the bottom, and then came back. And they've been really volatile, but the ETF and the tracking of its basket has been super tight the whole way through.
Yeah, true. Yeah, I think most ETFs do what they are expected to do, particularly on the index side and tracking their index. From a business standpoint, I was thinking it's tough for an asset manager to bank on a certain thematic, because once that trade goes out, it goes out for a little bit, and then you have to wait for it to come back in.
Yep. Yeah. I mean, there was a period about 15 years ago where water was a very attractive ETF space.
Yeah.
And all of a sudden, no one's doing water trades anymore.
What's one long-term trend you see playing out over the next year or several years?
So, I mean, I think something that's been really interesting is just watching ETFs close the gap on mutual funds. So we saw a smart beta come to market probably 10 years ago now, I guess, and it was really slow to get going. But like we talked about, it's kind of a different audience. It's the more retail audience. It's the buy and hold audience. So they didn't have explosive growth in any of their portfolios, because they were picking stocks pretty diversified with a tilt that was designed to outperform. There's been since then active transparent ETFs, the new non-transparent active. I mean, really the old days of thinking of ETFs as index funds and mutual funds as active funds has completely gone. Now we have ETFs that are active, and we have mutual funds that are index products, and everything in between. And I think that the trend that's going through right now, that'll continue for a while, is ETFs are a super easy way to get access to a managed portfolio. It's much easier to get into a mutual fund, to switch the mutual funds exposures, and I'm calling them mutual funds because ETFs are 40 Act funds for the most part. And so I think with everybody having electronic access to their retail brokerage account, it's really pretty easy to buy and sell ETFs. It's administratively easier. It's probably cheaper to cross the spreads. It's much easier to settle those trades. So I think ETFs are going to continue to close the gap on mutual funds.
All right. I'd like to hear that. Well, we also have mutual funds, but I'm on the ETF side, so yeah.
There will always be a need for mutual funds. So even when you have an ETF that tries to clone a mutual fund, what you'll find is the market makers will push back on the illiquid holdings, because they have to do creations and redemptions, which means they have to go buy the underlying basket. So if you've ever got a portfolio with a few stocks that are harder to buy or more expensive spreads to cross, you'll often find the ETF will cut those stocks out, and the mutual fund will still hold them. So I don't think mutual funds go away. I just think ETFs are growing, and they're 4.5 trillion now versus about 20 trillion in the mutual fund space. I think they'll keep catching up.
Yeah. Still waiting for them to really be introduced into the 401k space.
That would have a major impact, I think.
Yeah, I think so as well. All right. So you ready for our speed round? It's trend or fad?
Okay.
Don't be afraid. I think these might be easy. Financial transaction taxes, trend or fad?
I hope it's a fad.
So do I.
Yeah, I mean, it's obviously a hot topic right now with governments running out of money because of COVID. The reality is market makers only trade when they make money. And so if you add a tax, they're just going to widen the spread, which means most investors are going to have to cross a more expensive spread. So it's actually investors that end up paying the tax, which means that most of us end up having worse returns in our portfolios, and issuers end up having less interest in their stocks, which increases their cost of capital. It's apart from the fact that the finance industry might shrink as well, it's one of those weird counterproductive taxes.
Zoom weddings, trend or fad?
Fad.
I've also heard of Zoom funerals, which is interesting. The term K-shaped recovery, trend or fad?
I actually think that's a trend because the data actually supports it. One of the things we're seeing in the economic data right now is really disparate outcomes for different slices, whether it's just today I was looking at the fact that people with less education have lost more jobs and are having trouble getting back into work. People with higher education, not so much. You look at goods and services, people in the goods industry are actually doing better than pre-COVID. People in the service industry, not so much. And you could slice the data a lot of different ways. COVID has created winners and losers, which is problematic for anyone that's not on the winning side.
And then finally, cryptocurrency, trend or fad?
I'm going to sit on the fence on that. I can see. I personally don't see what the value of the crypto is, but it hasn't gone away yet. So I don't want to be wrong on that one.
Fair enough. All right, Phil, this was awesome. Thank you so much for your time. What's a good way for people to connect with you, follow you, read your research?
Firstly, thanks for having me. It's been great. And if people want to read what I write about in the podcast that I do, search for me at Nasdaq. I've got my own page on the Nasdaq.com website. You can click to subscribe and you'll get my emails and my newsletters as well.
Fantastic. And thank you for listening to another episode of Trends with Benefits.